Just very quickly, this particular slide is on the screen because I just thought I wanted to get some context. I know some of you, everything we're talking about is just stuff that you deal with every day. Others of you, this is all very new. We're going to get closer to a common denominator sort of by sometime tomorrow, I hope. And yeah, hopefully you just keep asking questions as we go. What I'm really trying to do is pull context in to talk about the different kinds of transactions. I've already said that kind of the secret to this understanding M&A is actually understanding it's not a discipline of law as such. It is just a particular application of some particular skill sets. So, and I would say the biggest of those is contract. So ultimately, these are about, M&A is about negotiating contracts to end up with a structure. Controversial to say contract because I think the other area is company law, clearly. And company law is a combination of the common law and statute. So when I say controversial, I don't think anybody's going to have fisticuffs with me over thinking about it more from a contract point of view. But I guess as a practitioner, I've always come to M&A transactions starting with the question, what are we really trying to do here? So is this a regulatory issue? Is it a contract or a deal? What is the transaction that we are trying to put in place for, and what is the reason for that? Often clients will come to you telling you what they think the deal is, but the magic is often in understanding what it is they're really trying to achieve, and then often highlighting issues to them along the way. It is not surprising that M&A transactions tend to have a team of advisors attached to them. There will often be a commercial advisor, that might be a business broker, it might be an investment bank, it could be any kind of commercial advisor who's really looking strategically, looking at the whole of the deal. You will almost always have financial people involved, both from a tax perspective, and tax in this sense is not only, it goes in a number of different buckets. So there are the tax consequences, income tax or capital gains tax consequences for purchases, income and capital gains tax planning. Sorry, I've said that the wrong way around. Income tax income and capital gains tax consequences for the vendors because they are realising an asset. Planning for the purchasers, how does this fit in with the group, concessions, things that they've already done. Then there will, in many cases, be stamp duty consequences. Less stamp duty consequences these days than there used to be, but particularly when you have assets, underlying assets that include large amounts of land or buildings, factories, other kinds of sites, there will be stamp duty consequences. So again, there will also be sideways tax consequences as well. So things like thinking about how GST might be grouped in the resulting transaction. So that kind of planning, those planning pieces happen. You will almost always have, not always, but yeah, no, almost always, you will have lawyers beyond just the M&A commercial transaction lawyer who is documenting the deal. I cannot think of any transaction over $15 million in my life, actually, where we haven't involved an industrial relations or HR employment lawyer of some sort, because we've got, unless there are no employees, but there are always somebody. There's EBAs. Yeah, and there's often EBAs, so bargaining arrangements, industrial awards, etc., that we need to deal with. There are tax consequences, less often now, but particularly if I've had a couple where there's been a company super scheme. So you can have complexities that come out that way. You will also often you'll have auditors involved. Often due diligence will involve looking at already audited reports and then going through the exceptions in relation to that. But you will usually have a strategic finance accountant as well, looking at how you're going to build out coming forward. So there are lots of different things, and often the role of the lawyer is to coordinate part of that. Because, well, why do you think? Why do you think it would be important for lawyers to stick their expensive little noses into all the different kinds of things that happen in a transaction?
To make sure that everything moves in the interest of the client.
Exactly. To make sure, well, even just from a documentation point of view, again, those of you who've done contract with me, contract is a verb. Lawyers are responsible for the noun. Our clients make agreements. Our job is to document, to create the noun, the contract, the agreement that reflects the agreement verb that our clients have made, unless we actually know enough about what the employment law consequences are, the industrial relations consequences are, the tax consequences are. We can't be sure that the noun, the thing that we write that reflects the verb, the agreement that people reach, actually meet those requirements. So coordinating and keeping that list of what the high level is. Now, that doesn't mean that we have to be all things to all men. And Carly can already see that I'm floundering when it comes to the tax stuff, right? I know when to ask a question. Okay, I will identify this is an issue that we need to explore, depending on the type of deal, the importance of the question, and the numbers that are involved. Then I'm working with somebody else to get me that information for how it impacts on putting the whole of the deal together. So why have I got this slide here? I just want you to get a sense of what the Australian M&A transaction economy is. And in particular, I mentioned earlier that Pitchers and a couple of other sort of medium-sized law firms are starting to do research now on the size of the market in Australia. I think this is their third report. I thought it was every 2 years, but these numbers would suggest 2016, 2017 and 2018. This report came out at the beginning of 2019. If anybody's interested, I can give you the URL to go and have a look at the whole thing. But it very clearly shows that most of the transactions, as a percentage of total volume of transactions that are happening in Australia, are happening in the mid-market space. So the 10 to 250 million space. So 250 million sounds like a lot of money to me. I don't have a problem that $250 million wouldn't solve. But it's not, as Michael says, it's really not in the context of the size of the deals that we're looking at. But having said that, so there are many more transactions. It takes a lot of transactions to fill in that dark green number. And there are teams of lawyers working on it. So, yeah, if this is an area of practice that interests you, this is what commercial law firms are doing day in and day out. And personally, I think it's quite fun. I like it, but we will see what you guys think over time. Open that up. Come on. Keep doing this for the first slide every time. You can take the lawyer out of the law firm, but it seems you can't stop them from time recording automatically, and I keep turning it on without remembering that it actually interferes with my slides. Isn't that sad? 30 years on and I still record my time all the time. I can't believe I do it. So we can't talk about mergers and acquisitions without talking about growth. And Michael used the word Ponzi scheme earlier today in a different context, but much of popular culture around thinking about M&A, when we think about M&A, and maybe it's just me, I go to the lowest common denominator very quickly, and I'm always thinking, well, what movies can I prescribe as, procrastinative viewing for you as you're doing this subject? And there are some really great ways to get to know more about this area on Netflix, effectively. The Big Short. I would highly recommend it, not only because you get to see Margot Robbie in a bath, but because Margot Robbie in a bath will explain in context some of the concepts that we're talking about, or the market context, Now, that's a movie about why the GFC happened. It's more skewed towards financial instruments than it is to the kinds of transactions that we're talking about, but it's a good place to start. But at the end of the day, the things that underpin a lot of that, and if we go back to the greatest M&A movie of all time, which is Wall Street, really, people, keep up. So if we go back to Wall Street, I mean, ultimately that's what it's about. I mean, it's ultimately about transactions that get put together. Bottom feeders, a lot of private equity there, but that's what those transactions are about, or that movie is about. Again, I don't think the sequel is as good, but both of them are worth watching. It helps you understand how the market works. But all of these ideas, these scams, these terrible things that happen, come out of this idea that we continually need to grow, that businesses, large businesses in particular, in order to be successful, need to continue to grow. They need to grow in size, they need to grow in profitability, and there is a sense that they need to grow in what I'm going to loosely call functionality, that as the environment around them, the business environment changes, that they need to look at alternative ways of making money or dealing with their competition. Of course, the problem with growth is you can't continue to grow forever. That if we actually look at the top 20 largest companies in the world, I should have actually done this before I spout off, but very few, if any of them, were in that top 20 list 20 years ago. If we even look in Australia, Australia's, because our economy is so much tied up in natural resources, we're in a slightly different position than if you look at the global market. But again, some of many of the biggest companies in the world, does anybody know what the biggest Australian company is if we take out the two big miners? So I think it's probably third.
CBR.
No, Australian owned, I'll give you a hint, not listed here, but by valuation. Company called Atlassian. Again, listed overseas. That didn't exist 20 years ago, right?
Another example would be Forestry, where it went from
Forestry
went from 20 cents to like $10.
Yeah, oh well, there's huge, there's movements. Australia is unusual because we do have so much in the mining sitting on our particular, on our exchanges. Australia and, well, actually Canada isn't as weighted towards resources anymore. But we're finding as the world changes, as there are new technologies, new companies, I think the first time I ever used Google was a couple of weeks after my son was born. He is now 20. Alphabet, which is the company that it used to be called Google, but Alphabet now reflects the range of different investments it has, is now effectively seen as too big to fail. It is just such a large and high-valued company. And it sells stuff that 20 years ago we didn't buy, right? We didn't buy the stuff that it built. So the world is changing, companies grow. Tech sector in particular, there is this constant seeking of growth. So why am I mentioning growth? Because growth can happen in a lot of ways, right? You can just get better and better at what you do and more profitable and leave your competitors behind. But a key strategy for growth is acquiring your competitors, acquiring other assets.
Topical one at the moment is WiseTech.
So, yeah.
I mean, that's their whole strategy.
Well, there's plenty of companies out there that has been their strategy, and there will be. Look, and I think that will always continue. And we see, I often feel like the market breathes. We go out, everybody's very pro M&A, and then we come in again, and we're divesting, and then we're out, and it's funny how, because for every divestment there's an acquirer, right? And, so there's always two sides, but it is almost like the market breeds. So we just end up with more and more of these big consolidated entities, and then instead smaller separate entities. It goes in and out. Things go in and out of vogue. Sometimes, and this is a discussion I think we'll have as we tomorrow speak more about IPOs in particular and talk about how the stock exchange works. To a certain extent, the very nature of the stock exchange means that companies feel that they need to do things because they're very short-term, in some ways, reporting lines. So they have to report, annual report every year, clearly, half-yearly reports, quarterly reports. Depending on how you've listed, you might need to do quarterly cash flow reports. You need to be showing that you are taking action all the time. Investors are investing on the basis that they will receive a dividend. So they're looking for that cash flow. So they're looking for cash flow from their dividends. So companies need to be able to release money. It makes it very difficult to plan long-term out, to basically hold on to your money to invest in a long-term project. If the market is sort of sitting there behind you saying, come on, hurry up, hurry up, hurry up, hurry up. So a way that you can show the market that you're doing something is by M&A. And whilst it's, I don't think ever stated to be that this is why we're doing something, I think that is a big motivation often is CEOs want to make their mark. Does anybody know what the average lifespan of not lifespan, but term of office for an ASX listed company CEO is?
It used to be 5 years, I'm not sure.
It's about 2.9 at the moment.
It's gone down.
So they have a very, you get your 100 days to sit and watch and work out what's going on, and then you get, you're expected to perform, make your mark, show your strategy, grow. So it's a high pressure environment. I still think many of them get paid too much, but at the end of the day, many of them earn what they get as well. So M&A, when we're thinking about motivation, a lot of the time before we do any transaction, our clients need to do the following, and so we need to be thinking about this. I'm about to swear. Come on, this is ridiculous. Here we go. So basically we're talking about identifying, so I really want to make this really basic at that moment. We're talking about identifying some sort of target or some sort of strategic need, and then assessing what the value of either making that acquisition or divestment, depending on which way we're looking at it, would be. And so identification is about going out and identifying what the opportunities in fact might be and whether or not there is interest, what makes sense. Now, I'll talk about the language in a minute, but that might be horizontal, as in bringing in a competitor, making something larger, or it might be vertical, as in purchasing part of your supply chain or your distribution chain in a way that allows you to consolidate value. So again, understanding from a client's point of view whether a transaction that they're looking at is strategic in some way or is it simply a financial investment. Understanding what's in it for the client and understanding how value is created in turn help us understand how we would document a deal, even before we structure it. And I think of these two things as being this kind of push-pull between the strategic reasons and the financial reasons. Both have different kind of value propositions, but for doing a deal in the first place. That earlier exercise we were doing was about trying to get you to start thinking about why. Why are we doing these deals? So thinking about strategically the things that a firm might consider, many would say that the only objective is to really think about what's in it for the organisation and its stakeholders. And I'm using the term stakeholders here really broadly because I am of the view that stakeholders is something bigger than just shareholders. Okay, so if we go back and we'll do some company law refresher as we get there, but if we think about what a company is, somebody, I thought it was Lord Wilberforce, but it could have been anybody, a long time ago said effectively that a company is a device that a gentleman can use so that other gentlemen can give them money that the first gentleman can take risks with. And if we think back to Solomon's case, any of you remember Solomon? We'll talk about it in a little while. He was the bootmaker who created a company and then lent it some money. And then the question became, could he get his money back ahead of the other creditors? He was a secured creditor, so he had priority. And effectively the judgment was, well, yes, if we create a company, the purpose of the company is to take risks with money, ultimately. Everything that the company owns belongs to the company and its shareholders do not own those things directly. And if a shareholder happens to lend money to the company, that shareholder is no different from any other person who lends money to the company and will be treated the same way as any other creditor to the company, because a company is a different thing. So we're a lot, and because Solomon's case is right back at the beginning, the birth of company law in a sense, we tend to think in company law about shareholder rights, directors' duties to the company and to shareholders. But as the cases have moved on and as the economy has moved on and the role of companies in the economy has changed so much over the 400 odd years that we've had companies in existence, I think there are a number of other stakeholder groups that are really more and more relevant here. Anybody want to toss in who they think might be relevant stakeholders? Employees, absolutely. Tax department is particularly good at looking after employees from time to time. I'm sure you could, but they do. So employees?
The communities that their business operations are touched.
Communities, like, can we be more precise there?
So a good example would be a mining company in Indonesia and the impacts to mine,
Yeah.
the impact on the local village,
So
pollution or contamination.
absolutely. So companies so we have obligations both to society groups, to the environment. Much of that is regulated by companies, by relevant rules. Can get complex when they're different. When you particularly say if we've got an Australian company operating in Indonesia, its local responsibilities might be quite different from the responsibilities that potential customers, shareholders and investors in Australia might think that their obligation should be. Shareholders, investors, I'm using those two terms sort of interchangeably mostly, but there's more ways to invest than being a shareholder. You can lend money, is a form of investment. It's debt rather than equity. But again, the bankers of large companies often have more insight into what's really going on than the shareholders do. Sorry, I'm just... Tell me, add in as you go, but if a company very rarely relies simply on equity financing, there will also be debt financing. Debt financing, surprise, surprise, that requires an agreement, a loan agreement. So a loan agreement will specify the terms and conditions, which usually will include what are generally called financial covenants. So if you borrow money, small business or a large business, you borrow money from your bank, the bank will say that you can use this overdraft or this fund for these particular purposes, and every month, 3 months, year, depending on how risky they think you are going to tell us, give us financial information about how your business is going. But in between, if any of these, and we call them financial ratios, quite different from the ratio decidendi. I can never say that word in Latin, but a financial ratio is literally a ratio like you learnt it in maths, as opposed to ratio, the Latin word that means the decision or the basis for the decision in a judgment. So a financial ratio will be something like that the percentage of your creditors who have owed you money for more than 60 days is less than 10%. If you breach that ratio, so when you think about it, it is literally a ratio like in maths. I've got 100 people who owe me $100 million altogether. Most at any given time, most of them owe it to me for somewhere between 14 and 30 days. But some of them take longer to pay. The percentage who pay me in 60 days or more is always going to represent less than $1 million, or $10 million. I think I said 10%. So usually a borrower will have an obligation if the financial covenant drops, whatever it is, and there'll be a lot of them. It'll be about your payment terms. It'll be about how much money that you've made, profitability. It'll range a whole lot of different things, whether or not you're using your working capital appropriately. All of those things, if you fall outside those ratios, you have a positive obligation to go and tell the bank that you're in breach, and then that might affect the way that they provide financing to you. So a bank will be an investor, and more banks in particular, the terms and conditions of advancing money will include those kind of society ratios, corporate social responsibility ratios. They will be asking you to report from time to time in relation to occupational health and safety, for example. Other kind of shareholders. It's a particularly important one we haven't discussed at all. Sorry? Customers, absolutely. Customers can... the thing is, customers don't like to be locked in. One of the biggest issues that law firms had merging, it's probably up to about 5 years ago, the 5 years before, there was a spate of international law firm mergers. I think following out from the GSC, there was a lot of consolidation, but also as businesses become more international, the American and English firms in particular, they're the ones that have affected Australia anyway, have needed to have an absolutely truly international presence. So there are some absolute mega firms in the world now. A lot of that growth was done by acquisition. So basically large firms in either the States or the UK, or China for that matter, taking a significant stake in firms here. So I say China because one of the biggest ones is the firm that is now King & Wood Mallesons, which was, and in fact Shine Wing, name on the door over on the board over there, is an example of a Chinese accounting firm that acquired a local firm here. What was it? Oh, I was thinking Moore something. Yeah, Moore Stevens. That's right. So yeah, they splinter out.
They change names.
Yeah, but it's similar in both accounting and engineering firms. Is the same. A firm GHD, which is one of the largest private non-listed companies in Australia, it's actually an Australian company who's been going and acquiring engineering firms around the world. Did a massive acquisition in Canada a couple of years ago, but customers don't always like it when a supplier changes the way that they do business. Particularly when there's potential for there to be a conflict of interest. If you're with a particular, there's always somebody who has picked their phone provider because they don't want to work with X, insert blue chip phone company here. When blue chip phone company then acquires your phone or your ISP or whatever it is, it can actually be really annoying. If you've and this has happened to me, had a bit of a hissy fit and decided that you are going to vote with your feet and go and leave a particular supplier to go and buy from somebody else instead, and 3 weeks later that person you had or entity that you have just left has acquired your business, it can be actually create a whole new set of issues.
When you read your contract, which is what happened to me when Virgin Mobile got rolled in a couple of Optus, and it says that Virgin Mobile can assign your service at any point in time to any provider that they choose.
Yes, exactly. And if you had read it at the time that you entered into that contract, you would have had absolutely no ability to negotiate that clause because they're quite happy to say no to you. But again, these transactions affect people. And I guess that's one of the main points that I want to make here, that all of these transactions affect people. They affect employees, they affect customers, they affect suppliers, they impact the environment that we're around. And so any transaction changes the way these companies do business and impact the value chain. Come on, Cathryn, what is going on? So again, these are just two halves of that same thing. So let me ask you now. It's basically the same thing that you got into before. We just didn't get there. I'd just like you to have a go at sharing what you think some of the key motivations for M&A transactions are. I can flip back to the QR code for those who prefer it, but otherwise if you hit theminty.com and use that code 703746, we'll gather the kinds of things that you think, and then we'll unpick why do people do an M&A transaction. Oops, wrong way. I haven't used this particular one before. I'm thinking it'll work. Ego. I'm so glad somebody has put that there because I think ego is there is, in my view, a lot of ego in the market at the moment, and I'm not just talking about you, Arthur Nemedes. Sorry, that's my business partner, Enjoy McCom. I'm clearly just losing the plot. Absolutely. Acquiring new technologies is a kind of diversification, isn't it? Got a few different things in there. It's interesting, isn't it, that we've got a few things there. All of those are right. All of those are reasons that people do transactions, do M&A, and they're all very different from each other. They overlap, clearly, but there are differences there. Keep scrolling up. Bringing functions in-house, I think, is really important. Feel free to keep adding. I think that thing's bouncing because there's a question that I haven't seen. This is new to me, but I will make sure that I get to them and answer all the questions as we go. Any comments? Any thoughts? I'm trying to highlight as much as anything that, again, part of doing M&A is understanding what those motivations are, because those things will go to the structure, and we'll talk a lot about different structures and different types of transactions as we go through. But it's also about thinking about what the contract needs to say, what kind of things we would need to include about it. I basically always end up coming down to this idea of synergy. And so here's a really fancy equation that I have here. Absolutely no magic to it all. NPV. NPV stands for net present value. For those of you who are not numbers people, that effectively means what is my company worth right now as a number. Net present value. So it's basically all of the assets I have less all of the obligations I have as a number. It's pretty straightforward. So it's effectively a synergy transaction means that if I've got two companies and I multiply the net present value of A and the net present value of B, so I merge them together, that putting those two things together needs to be greater than A by itself and B by itself. If we can't see that, whatever the motivation is, then we don't have the basis for an M&A transaction. Now, having said it's as simple as net present value, because there are accountants in the room who, and tax people, so we will have a definition of exactly what net present value is.
And NPV tools is one of the most misused tools in the world. You can make it say almost anything you want, any
True.
inputs you put in. So.
Well, and that's what I'm going to talk about. The inputs that you put in here, this is the secret to it, are the inputs that are important to your client. When your client is actually assessing whether or not there is an M&A transaction that is of value to them, it might be that it's strategic. That the value to them of taking on this obligation now in order to have that functionality in the next year, which is a defensive position against what they see coming in the market forward, that their bet, and it's usually a bet, is that it's worth spending this much money now rather than risking spending a lot more money in the future. And if we go back to what I was saying earlier, that at risk of absolute oversimplification in any transaction, we need to believe or understand that the vendor thinks that the money they're getting for selling the thing is worth more to them than the value of keeping the thing, and that the purchaser thinks the value of getting the thing is worth more to them than the value of the money they're spending, then actually that means looking at what it is that they're predicting or betting that they would have to spend in the future. When you're buying a cup of coffee in the morning, the caffeine hit that, if you are like me, you sorely need, is worth more to you than what you can spend that $4.50 on in the afternoon or in 10 days' time. If it's not, then you'll just keep accumulating your $4.50, and in 10 days' time you might have $45 and you might buy a coffee machine. Probably not. So again, that really goes to this same idea, where that push-pull between strategic reasons, which are valuable, and financial reasons. Having said that, you still need to be able to finance these transactions. So it is not as simple as saying, well, this is worth more to me in the future, so I will just do it, if you can't actually access the cash or the finance at that time. So there is a push-pull. But we as lawyers, we need to understand how these things fit together. For our clients, that is. So what kind of forces drive M&A? There are lots of them. People, particularly more and more, well, actually, again, I'll let you guys tell me if you think this is true. I am a little bit at risk of my own bias coming through because I do work in the technology space. But I think technological change and what we call disruptive innovation has been a real driver for the M&A transactions that I've seen. Does that term disruptive innovation mean anything to anyone? You hear it a lot.
Yeah.
It is actually used as a technical term. I'm swapping into MBA mode now. It's coined by a guy called Clayton Christensen from Harvard University. And it's basically a disruptive innovation, used as a technical term, is effectively the innovation you didn't see coming. So if you think about it, some of the big innovations that have happened over the last 100 years or 200 years, think about the light bulb. AC, DC power and the light bulb was a massive disruptive technology change, being able to light people's houses without candles and smoke. Prior to Edison and others and General Electric, who had this huge patent war over the light bulb, by the way, which is a fantastic book called The Last Days of Night, but I'm distracted. Prior to that, the people who were making money from lighting people's homes made candles and gas lights. Those people did not make money from light globes, ever. Prior to Henry Ford creating a automated factory that pushed off automobiles, you could have them in any colour you liked as long as it was black. Prior to the mass-produced automobile, the people who were making money by moving people from one place to another made carts. They were Wainwrights. No Wainwright or cart maker made money when the automobiles came over. So the idea of a disruptive innovation is a change or a way of doing something that changes a market so that people are now buying something that they didn't buy before. Now, interestingly, there have been some monopoly or large players in particular markets who have where those markets have been disrupted and changed, and they have continued. So think about telephony. The way we used to communicate with each other was over a wired telephone. The wired telephone infrastructure owners are making money out of mobile telephony and internet, and so it's not like it's an impossible thing to do, but often the disruptors, the changing technologies, are the ones that actually are competing in they're doing a different thing from the thing that you do. Is that a reasonable explanation of what disruption means? Because it does have a technical meaning, and we talk about disruption all the time, and I think people think of it as interruption, like something new has just come out of the blue.
Is that just like a buzzword that somebody could use to sort of say you're using it? This idea that you have is never ever displaced.
Well, and that's the thing. We don't know what's going to displace, and it's really interesting how the human mind works. We can't properly remember what it was like to not have the things that we use every day. Like, one of the big changes in my lifetime was the introduction of the first robots that we interact with every day, otherwise known as the automatic teller machine. Like, they are that's the robot I personally interact with most, less often now because we're all going cashless, right? But I actually have difficulty imagining how my parents organised their lives when they, before credit cards. Credit card is a massive even if you don't actually use the credit, the convenience of being able to buy something. But say if you've got no credit card and you're only dealing with cash, if you couldn't get cash out when you needed it, if you could only go to the bank, the words banking hours relate to when banks used to be open, 10 till 4 weekdays. If you don't get to the bank, how many of you have time to go to a physical place to get money or to do something like that, and then actually be able to work out exactly how much you need so that you're not wasting it? Because back they also used to get interest on their money. Life was very different back in the olden days. But again, I'm using that as an example because I think it's something we can all kind of relate to. It has actually happened in our lifetimes, for most of us, possibly not all of us. But that's been a fundamental shift in the way that the universe has worked. as its society works. Did the banking world imagine that one of the biggest disruptors to them would be robot manufacturers? I mean, at the end of the day, an ATM is a robot, right? I don't even think we think of that now. Yet financial services and banking in particular is being completely changed. The way that we do banking is completely changed as a consequence of technology. The way we trade shares on a stock exchange has completely changed as a consequence of technology.
But most plain vanilla stock brokerages out of business.
Yeah.
Because they have no reason to be.
They don't.
Not with the small.
No, absolutely. They don't need to exist. Are you going to say something, Sigrid?
No.
Are you waiting to be replaced by a robot?
Hasn't our life just changed? I mean, the way we do our shopping?
Yeah. The way we do it. Well, you're the one who told me that in the Netherlands you're paying for you basically, as you put the goods in the cart, they're being scanned and dealt with. I was reading something the other day about some data that actually now there are some supermarkets sometime in the world where they've got so many cameras that they can see people looking for things and what they put back and what they take out, and they can send information back to say, the Captain Crunch cereal should be put on a different shelf because people are having trouble finding it. And then it's like, oh yeah, here comes Nolan, she likes the organic oats, so let's just move some stuff within her eyesight, like 4 shelves down below everybody else.
There's also research that shows apparently that the larger volume shopping between 12 a.m. and 3 p.m. 3 a.m.
Yeah.
What? Yeah, apparently that's the busiest.
Yeah, but that's in the Netherlands where everybody's been eating those cookies.
Here, and we all thought, well, it's going to be.
But the point here, just to wind us back, because you know how easily I get distracted at all, but particularly in relation to technology. But what's interesting here is that the world is changing. Things are being disrupted, not necessarily by the things that we expect. Shopping, the way that we shop, is being disrupted by technology, by artificial intelligence. There was an expectation that the advent of email would mean that the post office would die. And in fact, there are more home deliveries than there've ever been before as more and more people shop online. The world and the nature of how we do things is changing, not necessarily because of what our competitors are doing, but because of what somebody in a completely different industry is doing. And so more and more of this kind of and the discipline, there's actually an academic discipline of foresight or futurism or futurology, which is not palm reading or numerology, but basically a cross-discipline approach to using data to try and predict how different technologies applied across different industries might impact the way that we do business.
Sometimes M&A is an imperative as well for survival. And a good example in Australia at the moment is in the transport industry.
Yeah.
So a lot of companies, particularly in freight forwarding and customs brokerage, what they find is in the old days there was a black box industry. Nobody really knew how they did what they did.
Yes.
And that's no longer the case. You've got companies taking that expertise in-house if they're big enough. So BHP does all their own transport because they can. And so the smaller players are getting squeezed because the competitive pressure on margins is becoming greater and greater and greater.
And when they're competing on price, then
there's no competitive differentiation. So the only thing they can do is get big.
Yeah. Sorry, I'm just keeping an eye on the time as well. So there's lots of different kinds of motivations. Often law firms will pitch their M&A capacity in terms of industry groups too. So they're keeping their eyes out on what's happening in resources and mining, or in financial services, or in logistics and transport, in education, in a range of different areas, and then looking for those synergies. Again, at risk of kind of over-egging the point that I'm trying to make, there can be lots of less valid or doubtful reasons as well. Sometimes diversification impacts the choices that investors make. And often when you're seeing M&A transactions that result in a breadth of investments, investors will find that difficult. So if I invest in a mining company and that mining company suddenly just diversifies into optical fiber cables, like that's not what my investment strategy was. I've invested in this company because I'm expecting that mining is going to go up. I've gone in when your price is low because I'm prepared to wait for a little while and see what happens later. Investors will often get nervy about that kind of behaviour. The other thing that we see a bit of, and this is often about the short-term reporting, is what's referred to in the market, and a lot of what I'm doing today is trying to get you some lingo, bootstrapping. So in other words, bringing in transactions to be able to end up with reporting that shows increased earnings per share, EPS.